walking towards right now?
This is the Figueroa, which is one of the main retail areas of downtown LA. And also right on the corner is 7th Metro, which is the main transit for public transportation.
This is a premier destination point. Food, retail, high-end. Hi, gentlemen. How we doing?
Doing good. As you can see, people are wearing their masks, practicing social distancing. All the retail shops are open. People are eating and socializing.
We're at LA Live right now. You can see people ordering food, eating, wearing the proper PPE. 865 Fig is perfectly positioned between hotel, residential, amenities, restaurants, and more. Can you tell us more about where we're standing?
So LA Live is the home of the Clippers, the Kings, and the world champion LA Lakers. There's the Microsoft Theater, there's a Regal Theater for movies, and right south of this LA Live entertainment hub is the LA Convention Center. Currently the LA Convention Center is closed due to city regulations, but as you can see, activity is starting to pick up, and especially outdoor dining. It's a premium. It's packed every night, and you can see that in our building too.
Gentlemen, we're back here at 865 Figueroa. Charlie, can you explain what's going on here at the building in a post-COVID environment?
The building's been quiet. Initially, we were in the single digits in tenant occupancy, but currently we're approaching 20%. We just got word from our third biggest tenant that they will be starting to phase in 25% of their workforce beginning in November. So I think incrementally we're going to start getting more activity here.
Charlie, what is the building doing to prepare tenants to returning to the workplace?
Well, the building has, first of all, usually went weekend mode. So there's limited access in and out of the building, limited to only our tenants and vendors that would come to the building that would have to check in with security. We have hand sanitizers, we have notifications everywhere, we have protocols listed in various locations, and we're following all the protocols of the CDC.
And it looks like from behind us we can see our security staff wearing masks as well. So it seems to be a requirement to get into the building. Everyone's wearing masks?
That's correct. We highly encourage it. We enforce it to the best we can. And if they don't have the correct PPE, we provide it for them.
And here we are with 6-foot stations going around.
Hey, why don't we go check out one of our tenants that's expanded during the pandemic.
As you can see, some of the protocols that we have for using the elevator.
Our janitorial services have been increased during the pandemic, doing hourly disinfectant of high touch points like these buttons, any door handles, any area that we feel that's a higher risk group. So here we are in Alan Madkin's new space on the 30th floor. They expanded approximately 12,000 square feet during the pandemic, and they are around 95% done. They're looking to get in around November 1st.
You can see they have directional signage on the ground telling people which direction to walk. They're practicing the proper PPE and safety protocols, such as having hand sanitizer on site, gloves, masks. All right, gentlemen, will the impact of work from home keep tenants from coming back?
The majority of tenants at 865 are in the legal and finance sectors. These were actually tenants that adopted to work from home earlier, pre-COVID. Smart tenants are viewing this as a temporary solution, and as Charlie alluded to earlier, we've had one of our largest tenants expand by 12,000 square feet during this pandemic.
And Charlie, how are the tenants coping so far with this pandemic?
We're in regular communications with the tenants at a minimum on a monthly basis. And there is a demand to come back to the office. That demand is getting stronger. So we're working with them in collaboration so that they can come back to the office when they're comfortable and they're safe.
We've enjoyed our tour of 865 in downtown LA. Charlie, why don't we go to the new restaurant Strata and have dinner and drinks?
Come visit us in LA.
Good afternoon again. For those who could or those who couldn't hear, I was just saying at the beginning of this that life is never dull. And clearly it is never dull, particularly where you've got technology involved. But I was really referring to the fact that over the weekend, we've had the US presidential and congressional elections, and we think we have a result, and we think it's for Biden, obviously. But even more exciting, overnight, we've heard this dramatic news from Pfizer and BioNTech in Germany that they may well have found a vaccine that has a 90% efficacy. And obviously this would be transformational. And clearly overnight we have seen, certainly out of the US, dramatic rises in stock prices, in particular some stock prices, and some dramatic falls, I would hasten to add, because early on in the evening, Zoom, who would stand to lose from a vaccine, certainly its share price had dropped quite dramatically. But let me move back to the main topic of the day, which is to talk about Manulife US REIT, or as we call it, MUST. So MUST was the first US office pure play REIT to be listed on the Singapore Stock Exchange in May 2016. At that time, we had just 3 properties. We've now increased that since 2016 to 9 properties through very careful accretive acquisitions, so that we now have 3 properties on the west coast of America in California. We have 2 in the Northeast outside New York in Jersey and Jersey City. We have 2 in the Washington area, Washington, D.C., 1 very, very close, just 100 meters from the White House. And we have 2 down in the southeast of America in Atlanta, Georgia, very much the hotspot of the result of those elections just last weekend. We have increased our AUM over this time from $777 million US dollars to $2.1 billion US dollars in AUM. And we have buildings that are in an array of types of locations, not gateway cities, but suburban, urban, and central business districts, or CBDs. We have amassed top trophy and Class A properties. And it's those sorts of properties that have been proven to weather all market conditions. We've also aimed in those top class buildings for superior tenant types that are prepared to sign, in normal conditions certainly, but are prepared to sign these very long sorts of leases that you see in American office of 5, 10, or 15 years. So that's the background. So let's move on and see where we are as of the end of September 2020. Well, we have, of course, been driving through the headwinds of the pandemic, of the US economy crashing, and then starting its recovery. In this extraordinary year to date, with the third quarter accounted for, I'm pleased to say that MUST's high-quality portfolio has stood up to these adverse conditions and remained resilient. Indeed, over these past 4.5 years, investors and the market have come to expect MUST will deliver strong and stable results in a measured way, always in readiness to position and seize further growth. So we're pleased to report that at the end of the third quarter, despite the disruptions and the uncertainty generated by COVID-19, MUST fundamentals remain solid. So, for example, our occupancy is at 94.3%, which is well ahead of the average for Class A property in America of about 87%. We had a slight dip from the half year. We were at 96.2% at mid-year, but this was mainly due to the known expiries and absolutely not related to COVID, i.e. to tenants downsizing because of work from home. And I would just like to remind the listeners that there are no rake clauses in American office property leasing. So we have, of course, over the third quarter been very busily working on leasing with a number of tenants such as in the legal and finance area. But it has been a slow quarter. Of course, it's traditionally the holiday period in July, August, and September in America. And leasing was indeed rather slow, as many of our tenants, existing tenants and potential new tenants, took a wait-and-see attitude. But of course, it must be remembered that in the first half of this year, we had been very fortunate to lease 217,000 square feet and at a positive rental reversion of plus 7.9%. We also have a long weighted average lease expiry, or WALE, of 5.5 years to help us tide over these rough sort of patches. And that WALE was boosted by the strong first half leasing, which had an weighted average lease expiry of 6.9 years. And then our top 10 tenants have a weighted average lease expiry of 5.9 years. So you can see that our leasing can weather these sorts of storms. The matter, frankly, that has dominated all the REITs' lives, I think, over the past many months of the COVID pandemic, has been rental collections. And we have been giving investors frequent updates. And our rental collections have continued to be strong. So they stood at 98% by the end of September 2020. And that included 94% for the third quarter. Now, we go on collecting rents from tenants because some of them have, quite frankly, for one reason or another, been slow to hand over their checks. And we do see increases from the data on almost a weekly basis. And indeed, even at the end of last week, we saw that 94% creep up to 95%. Feels a bit like election results, this. There's also, been very fortunate in that we have a small percentage of those who we've had to give deferment to. Indeed, for MUS portfolio, at the end of September, deferment stood at just at 0.3%. Equally, for abatements, it's also a very low figure at 0.2%. So that has a very minimal impact on income. The areas that have been slow to pay, perhaps unsurprisingly, have been F&B. Many of those little cafes that amenitize our buildings have had to close for a period, although some are now reopening. And other lifestyle and retail tenants have also had a difficult time, as you might imagine. We're also frequently asked about the level of subleasing in buildings, because if you can't break a lease but you have some spare space, what can you do with it? Well, in our buildings, you can sublease. But again, I'm pleased to say that our subleasing from our tenants stands at just 3.3%. In terms of our financials, gearing at the end of September was 39.9%, and of course that is well below the current regulatory limit of 50%. And on the financial side, in terms of our balance sheet, that remained robust, with undrawn committed credit facilities of $134.5 million, same as previously announced, and that would give us a backstop if we ran into trouble for some reason. So just looking at our debt and where we stand, we have, of course, a well-spread debt maturity, which gives us great financial flexibility. And this year, for the rest of this year, we have no further financing or leasing to achieve. We did extremely well in June of this year when we refinanced our Atlanta, Georgia mortgage at a very, very low rate of about 1.85%. So we're looking very eagerly, and we're already well down the road in terms of the negotiations for those 2021 leases. And those previously, the rate on those was a blended rate of 3.19. So if you think about that, and the fact that rates are still very, very low indeed and are expected to stay that way for some time to come, and we look at the rate we paid for the Peachtree building, I think you can see that there are going to be some great savings from this year's renewals of loans and refinancing, and indeed as we get into next year. I've already mentioned expiries, and just moving on, you can see here that for the rest of this year, we have about 1.5% by MLA in terms of further expiries. And for next year, really a manageable amount of 6.4%. And we're fortunate to have that. And again, I think I remind everybody that our occupancy stands currently at 94.3. So we're in good shape in terms of that. Also, I think it's worth noting that our leases are at the moment, our rentals rather, are some 6% below the market. And so that does give us flexibility when we're renewing new leases or expanding with some tenants. And we have done some expansions this year because it gives us flexibility to perhaps have blended leases or to give very good rates on shorter term leases, but then blend into 5 or 10-year leases further out. So we're in good shape there. Here's a little bit more data on our year to date. 4.6% of the portfolio to the end of September was renewed with those positive rental reversions. And I think, again, it's good to remind people that we have in America on office leases annual rental escalations throughout the term of a lease. And ours average at 1.9% automatic increase in rentals per year. So that, again, will tide us over as perhaps we see some little bit of softening in rents over this end of year and into the early part of next year. Let's just a reminder here on the strength of our top 10 tenants and indeed the diversity of our portfolio. Over this last 4.5 years, we have determinedly been diversifying our tenant base. And we now have 17 diverse trade sectors, including legal, finance and insurance, very, very strong sectors. And over 50% of our tenants are from listed companies, governments, or headquarters. Indeed, from our 180 odd tenants, 35% is made up of HQs. So, but in addition, of course, we have been targeting those higher growth tenants from the tech and the healthcare sector. Indeed, we have a Quest from the healthcare sector in one of our buildings up in New Jersey, which of course has been busily in diagnostics testing, has been the main tester in America. So we have a very interesting group of tech and healthcare tenants. Another important point here is how has rental growth been and how does it look going forward? Well, over the last 12 months, the rental growth in our locations has been 0.9%, which is much higher than the average for the US of 0.2%. Also, in terms of supply, this is not a concern to us in any of our markets. So, for example, in Washington, D.C., where there is some supply, it's not comparable for our buildings because the supply is in the trophy class and our buildings in Washington and nearby are Class A. So it's not the same competitive set. Equally, in Atlanta, certainly in Buckhead, we've got 100% occupancy at the moment. So we're certainly not concerned there. On supply, I would say in terms of further new supply, it's a brave real estate developer and a brave lending bank that supports putting a spade into the ground at this point, even with the potential for a vaccine. But the other part of the story, of course, is that in another year or two's time, the situation could be very different, and we might actually see a supply shortage. So that's something to conjure with for the next couple of years. So here, I just wanted to give you some flavour, in addition to the video that you saw earlier, in terms of what's happening with our buildings. Life does go on. There is a gradual return to the buildings. And I just wanted to show you, since March, for our buildings, they were all open. All 9 of them have been kept open the entire time. Occupancy was very low, obviously, at the beginning, but gradually we have seen people return. So the average is just under 15%. We saw a dip during the time of protest a few months ago, But now, again, as you saw and heard from our video, we are expecting tenants to return. So in our Figueroa building, our major tenant is planning to get 25% of their workforce back by the middle of November. But this brings me on to really a topic that has been incredibly important for us all as we've thought about the COVID crisis, and this is working from home. It really has been a critical topic. And frankly, we all need to get our heads around this even more so, and how the future will develop if there is going to be a vaccine that's going to be rolled out next year. Will people still want to work from home? Well, I think we must start by looking at the major difference between Asia working from home and working from home in America. Basically, in America, people have been working from home since the 1990s. They more or less invented working from home in America. And over the years, and indeed the decades, working from home has increased to some 54% of the office-using workforce. And this means that for office workers, they were eligible to work for at least one day a week from home before COVID struck. So eligibility is the main part, and eligibility has become entrenched in the US way of office working. And it truly has been an era of mobility. And so it's perhaps unsurprising, as you can see, that actually when a recent survey was taken, that people actually are wanting to go back to the office, and there's only an incremental of 2% more workers who now want to work from home in America than when they look beyond the pandemic than they did previously. So, it is not something that is taking hold. In fact, if anything, there seems to be a great desire to get back to your office. So what's the impact on Musk's portfolio from working from home? Well, I think in many ways we're gratified, again, that we're not in the dense CBD gateway cities. We are in location-wise in urban and suburban locations, and we are in those less dense CBD locations, less dense, for example, Sacramento versus, say, the CBD of San Francisco. And of course, we know that for some of these gateway cities, people have just not been keen to take public transport. Of course, another feature from our portfolio is that, and many people don't realise, is that there is less of an impact on, or we're witnessing less of an impact on our top sectors, such as legal, insurance and finance, because those sectors were the ones over these last decades that were actually the early adopters of working from home. And between 60 to 75% of these sorts of workers were already eligible to work from home. So we are not expecting a significant further attrition in this top area. So we think we're very fortunate. Of course, the other factor is that perhaps because the COVID won't go away completely, even with a vaccine for some time to come, that actually firms are scratching their heads and still not wanting to make any near-term decisions because they think that they're probably, as they get their workforce back, they're going to have more space for them because they've got to accommodate safe distancing. Hot desking has obviously had to stop. And indeed, staff that are working from home and working in the office, they need to have a designated space. So it's a very interesting situation. On the next slide, I just wanted to emphasize the point that we believe that the thesis for the future of office remains intact. There has been this structural shift going on now for many decades in America towards the knowledge economy, and it continues to drive demand. And again, if you look on page 28 after this presentation, you will see the relentless drive and rise of office-using workers as a percentage of the overall employment rate. And of course, we all know that people want to get back in the office for collaboration, innovation, productivity, security, and to encourage the talent of the next generation. I'm not going to dwell on this next particular page, but I just wanted to make one particular point, and it really goes back to that point I've just been mentioning about young workers. There was a terrible shortage of office workers across America before COVID. And indeed, unemployment in that area was only 1.5%. Now, unemployment of office using is currently in America only about 3 to 3.5% versus the overall unemployment rate of about 7.9%. So you can see that there is still a huge shortage of office using employment. So one way or another, our tenants are going to have to find ways to encourage and lure their staff, and particularly their young staff, back to the office. And we believe that our buildings are ripe and well positioned for that. So looking forward, so we've been hunkered down and we've managed the impact of COVID, but where are we heading to now over the next couple of months and into 2021? Well, first of all, obviously, we've already mentioned that we feel well positioned to make our refinancing. We're also working towards paying out 100% distribution for the second half of 2020 and also into 2021. We're focused on attracting more quality long-term tenants from that strong trade base and trade sectors, and we're also aiming for those higher growth sectors. We've also, in the last few years, spent a great deal of money in terms of AI improving some of our buildings. For example, we made some major spending on our lobbies in the Figueroa building. I think you saw that, that very glamorous cathedral-like lobby area, and also in our 10 Exchange building up in Jersey City, just across from Manhattan. Now, it's turned out that the completion of these projects has occurred just at the right time, when we will hopefully start to see a big pickup in leasing as we go into the new year. But above all, it's been important to weather the disruption of 2020, anchored by this quality portfolio, but also to note that since September, we have started to view a number of acquisition opportunities. Now, these must be accretive, and so we will continue to do the right thing for you, our investors. We've built a secure foundation, and now we can adapt to future changes and widen our horizon in the portfolio. As ever, management, along with our sponsor, Manulife, is committed to bringing you a reliable investment vehicle and product. And I'd just like to leave you with one thought at this moment today, as we are on the brink of finding the vaccine, is that we currently stand at a yield of 8%. That is a massive yield for this sort of quality and value of property. So I would say to you that at this particular point, must is of great value. And so, as I say again, on the news of the vaccine, don't miss the boat in terms of must. Thank you.